Welcome back, people. Today we're going to be looking at the income statement, as I've alluded to last week. The income statement is one of those financial statements that's going to tell you a little bit more about a company's financials, about a company's numbers, and how it trends over time. The income statement is also known as a profit and loss statement. If you're ready to become a financial detective and an underwriting badass and uncover secrets behind the numbers, this episode is for you. So, the income statement, what's the big deal? Think of it as a financial storyteller of a business. It's like that juicy novel that reveals all the drama happening in a company's finances. It's going to sum up all the money that's coming in, all the expenses that are going out, and the thrilling gains and losses over a specific time frame. You'll usually find this in like quarterly or annual reports of public companies. So in properties, we're going to have to request these from the property owners. And in simple terms, the P&L statement shows the gross revenue, the expenses, and the resulting net income of the property. If you truly want to understand how well a company is doing, this is the document that you're going to be diving into. I really only rely on the income statements. Now, if there's something that's iffy, that's when I utilize the other two financial statements. So my true love is for the income statements. When you're looking at an income statement, it's going to have several sections here. The first section you're going to see is the revenue. This is going to be the total amount of money that the company earned during a specific period. Usually you're going to be looking at probably a year's worth of time, or maybe sometimes you're going to be looking at a year-to-date form, which could have X amount of months in it, depending on how many months you are into the new year. The revenue is the top line of the income statement. Expenses are your next section. These are going to be the costs that are incurred by the company or the property in order to generate revenue. It's like all the cash that you have to burn in order to keep the lights on and the business running. So within the expenses, you're going to have something called costs of goods sold, or COGS. These are going to be the direct costs attributable to the production of the goods sold by the company. If you're selling shoes, this is going to include the cost of the materials and the labor that went into making those shoes. Or if you buy a product from some wholesaler or distributor, the cost of goods sold would be the cost of you acquiring whatever product that is. Now you also have operating expenses. These are other expenses that are not directly tied to the production of goods. It's stuff like rent, utilities, and salaries if you have a payroll. So in the property business, now sometimes you might have a property manager that's on site or an employee that's on site getting paid a salary or some type of dollar amount per hour. So those would be fallen under operating expenses. Now, a lot of times you're going to have to market your property. So you will have a section for marketing. This is going to be the money spent on promoting and selling whatever you're offering. And in our case, it's most likely going to be space. We're going to be offering space to people or tenants or business owners in order to rent from. Then sometimes you're probably going to see a general and administrative expenses section. These are the catch-all expenses like administrative costs, office supplies, and pretty much everything else that keeps the office running. The next section will be your net income. This is going to be the total profit after all of your expenses that we've just talked about has been deducted from your revenue. It's your bottom line, and it shows whether the company or the property is actually making money or just spinning its wheels. Sometimes you might even see a section for depreciation. This is actually a non-cash expense that reflects the decrease in value of assets over time. If I were to give you an example, it's like the slow decline of your car's value as you put more miles on it. I mean, in most days, as soon as you drive it off the lot, it loses, 20% of its value the moment you leave the lot. I also want to give you an idea of what EBITDA is. It's EBITDA. It stands for earnings before interest, tax, depreciation, and amortization. It's a measure of a company's operational performance and it gives a clearer picture of the profitability because it adds back depreciation and amortization. Sometimes you might run into EBITDA when you're evaluating a company or maybe even a business, or maybe you're looking at a business and the real estate in general. So these numbers are very important. And you're probably thinking, why do we care about all these numbers? Well, they're important because accountants, investors, and other savvy folks, they regularly dive into these income statements for valuable insights because the numbers are going to tell you a story. They're going to tell you everything that's happening with the property. It's going to allow us to assess the performance of the property or the business in general, and it's going to help us figure out if the business is making money, and it's going to show us how much they have spent in order to keep the lights on, and it also lets us know, how much profit we're going to make, right? If we're going to buy this operation, we want to know how much money will it profit us when we take it over. And lastly, it also looks at financial trends. You're going to be able to pinpoint the highs and the lows and the costs and expenses, or if there are fluctuations in taxes, insurance over the years, whatever. And by looking at that, it allows us to predict into the future when we take over the property. It allows us to hedge our bets a little bit better. A lot of times when you're looking at public companies, it's super important for you to look at the balance sheet along with the income statement and the cash flow statements. But for the purposes of looking at properties, the income statement is generally what I focus and entail all of my time into. Now, once again, if there are some red flags that are thrown out, I'll dig into the balance sheet, I'll dig into the cash flow statement to figure out where those numbers are off and why. And that wraps up our dive into income statements. Remember, it's super important for understanding the financial health of the property or the business, if that's what you're buying, and it allows you to make more informed decisions. Remember, the numbers are going to tell you a story. You just have to listen to what the numbers are telling you. And that's a wrap. If you found the episode helpful, make sure to subscribe, and I will catch you guys next week.